Start recording. That's always important. Sweet. I hope you were all doing well, and hope you didn't miss me too much last week. Speaking of, in today's class, we're going to go through a little bit of review of some of the short-term strategies we've been covering, because I know there's some brand new people in here going through the short-term strategy review, if you will. Again, those of you who are brand new, if you don't know me, my name is Steve Nuri. I've been trading in the markets for about, 17 years now, and I'm only 21 years old, which is odd, very odd. But I started off as an options trader, moved on to futures, then into Forex. I've been an instructor for the major exchanges. I've taught for the CBOE, I've taught for the CME. I've literally traveled around the world teaching the foreign exchange markets because when you're a trader in Chicago, you just get used to leverage. You like leverage. That's what you're passionate about, and you're always seeking more of it. So I started off as an options trader on the floor of the CBOE, and then moved on to one of the largest options trading desks in the world for a large retail broker. Then moved on to trading futures, seeking more leverage, and then found myself in the Forex markets. Now, with that background being said, let me just state that, with great leverage comes great responsibility, which moves us on to our next little slide here, which is our risk disclaimer. This is risky. We are all seeking what we call higher yields in our investments. This is what you call speculative trading. You are speculators when you are traders. You should only use risk capital in which to trade this market, and past performance is not indicative of future results. I'm not going to go on a big risk disclaimer soapbox here. However, one thing that I want to mention to a lot of you that have been in the class before is, especially when it comes to PitView itself, when you're looking at any type of tool, what I find with a lot of retail traders that I've taught over the years, and I've taught retail traders that have moved on to become professional money managers and professional traders. I've taught retail traders that have totally blown up their accounts. It seems like with a lot of people that enter into this market, they really don't have what I call a high risk appetite. The reason why they look for tools such as PitView or any of the other technical indicators that you put on a chart is because they're trying to seek something that's going to make the market less risky for them. The only thing that makes the market less risky for you is you, and that's your money management skills. The reason why people lose so much money in the market is because they look for that crystal ball approach. They go all in on one trade, and then they blow up their account in one trade. PitView is a tremendous tool. Those of you who have followed me for a while know that in my history as an instructor, I've never really endorsed any type of indicator or tool in the market. In fact, I've always been more of a price action guy. I've always traded more from price than I've traded from anything else. What that means is I don't put a lot of like stochastics or MACDs or RSIs or anything along those lines on my charts, because I think that price tells the story. The reason why I do find PitView to be such a powerful tool is because that it does give you a view of what's actually happening at that magical little area between the bid and ask price. However, just like anything else in the market, there's no 100% success rate in anything. However, as you get used to being a trader, you find that what you're looking for is every trade starts off as a coin flip, heads or tails. You got a 50-50 shot every time you get into a trade. You're either going to buy or sell. It's either going to go up or down, especially in the Forex market. There's no better example of that. And all we're trying to do is find tools and strategies and methods for trading that get our trading above a coin flip. Whenever I talk to fellow traders, and they're trying to explain the methods, a common thing that, kind of an inside thing that traders will say to each other is, how's that strategy working for you? And it's better than a coin flip. Nobody's really seeking perfection. They're seeking, through disciplined money management, they're seeking a strategy or a method that gets them better than, that 50-50, those 50-50 odds, and higher risk reward ratio on their trades. So I don't want to soapbox too much, but as we go through, class and as we go through these different types of methods and as we go through PitView as a tool, I always want to keep it in the back of your mind that just like with any tool in trading, it always helps if you actually know a little bit about what you're doing to begin with, such as PitView. The reason why I go through strategies and methods with you is so that PitView works the best as a confirmation tool for trading, as being able to confirm. Once you get a buy or a sell entry into a trade, it works really very well, better than any indicator I've ever used or tool I've ever used in my life. It works very well that when you get an invitation on whether to buy or sell to enter into a trade, PitView can confirm whether you should accept that invitation or not. And as we go through some of these examples and just review some of these short-term strategies, one thing also to keep in mind is that people tend to make tools and indicators way more complicated than they have to be. PitView is not complex. It's actually very simple. All the numbers are being measured off imbalances, buy and sell imbalances from the liquidity providers, the people that are driving the market action. So it's a very simple tool to use. It's just with anything in my history as an instructor, people tend to take simple, very simple things and then turn them very complex. So try to keep it, try to simplify it in your mind as much as you possibly can. So today we're going to go through a little review of short-term strategy. And then continuing on into next week when we meet up again as a class, I'm going to step it up a bit and we're going to go through more swing trading methods in the market. Now, the two strategies that we had discussed as a class as far as short-term trading are actually two strategies which I utilize in my own personal trading. I never teach anything to people that I've not used myself, that I don't actively use myself. And these are two of my favorite strategies for trading in the markets as far as short-term goes. Whenever you're trading, especially over the short term, what do I mean by short term? Short term is pretty easy to define in the markets. Short-term trading in the Forex is generally a trade that's going to last 24 hours or less, an intraday trade, if you will. It doesn't mean that we're scalping the market and placing 15 or 20 trades a day. When I define my own short-term trading, I'm generally looking for the highest probability occurrence throughout the day and just placing like one trade a day in my short-term trading. Now, if you're a short-term trader, I feel like there's always two tools, two different types of methods that you should always have in your arsenal, in your ammunition pack, if you will. You should be able to have some type of strategy for trading momentum in the market, meaning the first big move of the day, or the bigger moves of the day, and then some type of strategy for trading reversals in the market, that as prices tend to overextend themselves, they get into what we call overdone conditions, meaning the markets don't really move an unlimited amount of pips each day. We've learned that since the beginning of the year with the low volatility market that we've been in. So prices tend to exert a certain amount of price action and then reverse course for the day to some extent. So those are the two strategies that I think a lot of intraday traders should have in their arsenal. Trading momentum, which is the bigger move of the day, the momentous move, and then reversals, which are generally the reversal of the initial momentum movement. If you're confused on that, so am I. I'm just kidding. We'll go through that. So taking it easy today, I just want to review those two strategies with you. We'll go live and maybe look at some charts and see what's shaking out today. But as far as trading method, let's go through the London breakout trading strategy first. So this is a 5-minute chart. That's the time frame that you use to execute on this individual trading method. The setup, since we're trading during the London session from open to close is from 3 a.m. Eastern time. I apologize. I generally speak in terms of Eastern time whenever I'm in these classes. The London session starts at 3 a.m. Eastern time and goes through 12 p.m. U.S. Eastern time. And that's generally going to be the most actively traded market historically from a volatility standpoint as far as between those times when the majority of momentum occurs in the market. So since we're trading during the London session, that includes the London and European markets, we want to focus in on the pairs that trade most actively during that session, which are going to be, or the currencies, which are going to be the euro, the Swiss, or the pound. Generally speaking, people that utilize this strategy do it with the dollar-based pairs, which are called the majors, like the euro dollar, dollar Swiss, or pound dollar. However, I have had students that have done these strategies utilizing like pound yen, euro yen, pound New Zealand, if you will, to great success. But the rules will remain the same as far as what you look at. The 30-day ATR is something that we use. Now, I don't use a lot of indicators in my trading. I use what's called an average true range. The reason why we use an average true range is because it measures volatility in the market, and it gives a trader a good probability or a good idea of how much currencies trade in a given day or a certain time frame, if you will. It's generally more to have some type of expectation of how much I expect a currency to move each and every day. It's funny because for years I used to do the range on a spreadsheet. I would keep spreadsheets, and I would basically just copy down the highs and the lows each day for every currency pair and then average them out myself, until I went and did a workshop in Singapore one time, and a student explained to me, you know, there's an indicator that actually does that for you. And I was like, well, okay, I can throw away the spreadsheets now. So the 30-day ATR, I'll go into more details on that here in just a second. And then PitView. PitView is vital in this particular method for me right now because, you know, since I've started using it, because this is the epitome of how PitView can work in your trading and keep you out of bad trades. Meaning, what we're trying to do is we're trying to catch the first momentous move of the day. Now, with any trading method, you often get what we call whipsaws. If any of you know what a whipsaw is, a good example is it today on the dollar Swiss, where we got a whipsaw effect, where I didn't get into a trade based on what PitView said at about 3 o'clock this morning, to where PitView can either confirm this breakout for me, or it can tell me not to get into the trade. And it really saves me from what we call the whipsaw effect. What is a whipsaw effect? Somebody just asked that question. It's when something goes and triggers an entry and then comes down and stops you out. It just whipsaws you in and out of the trade. It gets you in, bam, comes down, stops you out, you lose money. It's like, ah, shoot. How did that happen? So PitView, using this as a confirmation indicator for this trading method, is crucial because it keeps you out of a lot of those trades that are, it basically helps confirm the good trades and keeps you out of the bad trades. Not all of them, because nothing keeps you out of all the bad trades, but it certainly increases the probability on this. And then the entry is what we call a consolidation breakout. What we're generally looking for is we're looking for price to consolidate on either the euro, the Swiss, or the pound during what we call the Asian session or the Austrasian session, if you will. And then once the price consolidates and we have a confirmed consolidation occurring in the market during that session, we're looking for price to break out in one direction or the other when the London traders hit their desk and a large amount of volatility starts to hit the market. Exit, one-to-one risk reward. I don't know if I did a good enough job explaining one-to-one risk reward. Let me pull up my pin. I always like using my pin on here. I don't know if I did a good enough job explaining one-to-one risk reward or why it's crucial. Let me just touch on that quite a bit, because there's a large debate amongst traders of what we call risk-reward ratio. What's a proper risk-reward ratio to use in the market? Whenever I teach my students as an instructor, not only do I teach PitView, but I also teach trading methodology, if you will. One-to-one risk-reward is what we call a minimum risk-reward ratio. What that means is, you know, people will look for like 1-to-2 risk-reward ratio, 1-to-3, 1-to-4. One-to-one risk-reward is always a minimum. It always gives you the highest, what we call probability of profitability, without going to what we call a negative risk-reward ratio, which means that you're risking more in a trade than you're willing to reward yourself with. So whenever I explain trading methods to students, we always come within what we call a one-to-one risk-reward ratio as a minimum. That means you're risking the same amount on a trade that you're willing to make back on a trade. And generally speaking, that's your starting point on every trading method. And you have to kind of use your head from there and use the gray matter between the ears to see if you have a higher probability of getting to a higher risk-reward ratio. There's certain strategies that can give you very good opportunity for, let's say, a 1 to 2, 1 to 3 risk-reward sometimes, and sometimes when it's just more where it's just more diligent of you to just use a 1 to 1. Now, step 1 on this trading method, I'll try to spend the first half hour going over the London breakout and the second part of the class going over the reversal strategy. This may sound funny, but even though we're trading from a 5-minute chart, we're going to look at a daily chart first. This is an exercise that I have all my students do, because not only does it force you to look at a daily chart and look at where the bigger picture stands, but it also gives you a great feel for what the overall prevailing trends are in the market. So step 1 is finding the 30-day ATR, the ATR being what we call the average true range. And so what you'd want to do is on the pair that you're trading, and again, you can do, a lot of my students do this on the euro dollar, the dollar Swiss, or the pound dollar pair. You can trade any one of those pairs. Those are probably the 3 most commonly traded pairs. You generally want to choose one of those pairs each day. One of my most common ones that I've used recently has either been dollar Swiss or the pound dollar. Is go to a daily chart on one of those pairs and find the previous day's closing 30-period ATR, which is the average true range. Sorry, I don't mean to write so much on here. I keep on using my pen. So what does this look like on a daily chart? If we're looking at something like an example here that we used in class a couple of weeks ago was the euro-dollar pair. The ATR, it looks like an indicator when you put it on the bottom of your screen, but what is it really measuring? It's measuring what we call volatility. What it's doing is it's going back for the previous 30 days on a chart. It's adding up the range from the absolute high to the absolute low each and every day. So on day 1, if it's 50 pips, on day 2, if it's 100 pips, on day 3, if it's 120 pips. It's adding up all the pips that it's moved each and every day for the last 30 days, dividing by 30, and essentially giving you a 30-day moving average, if you will, of the range. Why is that important? Because it's a good measure of volatility. As the time that we did this class, when you look at where volatility was, almost a year ago, the euro dollar was trading almost 80 pips a day. Now it's down in here to where it's trading closer to about 50 pips a day. So volatility going down in the market has been a lot of it coming from indecision from one economy to another, but that's a different story altogether, which we'll save for another class. So when we look at this number right in here, essentially what we're doing is we're saying, okay, what's been the average move of the euro dollar over the past 30 days? Well, it's moved an average of about 50 pips. Okay, well, if I'm going into a trading day to where I want to hold a trade for 24 hours, and I know in that 24-hour period that the euro dollar, between its moves to its absolute high to its absolute low, has moved an average of 50 pips, that gives me an idea going into my trading day of how much movement that I can expect on just a purely technical day on the euro dollar pair. Now, the reason why that's important is because of the fact that when you're looking at trading in the Forex market, a lot of people have a misconception that the market moves an unlimited amount of pips each day. Some people have a misconception that the euro dollar might move 150, 200 pips a day. And that's just not the case. That was the case a couple of years ago, maybe, but not now. This low volatility is not going to last forever, but right now we are on what we call a low volatility market, and the summer months does not help when it comes to trading these pairs. But it's been where we've been for the last 7 months. So that's your expectation of movement for the day. So moving on to step 2 here. Whoops. Find the Asian Sydney range. This is also what we would call the Austrasian session. Unfortunately, for those of you here in the U.S., if you want to trade more the large momentous moves on some of the most actively traded pairs like euro, Swiss, and pound, you have to be able to withstand the time frame that you'll be trading at. This is a strategy which I'll generally wake up at about 2:30 in the morning to trade. And so, you know, you got to get used to that, especially if you live here on the East Coast. For people that live in Hawaii, this is an awesome strategy for you. So on a 5-minute chart, what you're going to do is you're going to go from the Asian or Sydney high. You're going to find the Asian Sydney high from 5 p.m. and find the Asian to Sydney low from 5 p.m. to 2:59 a.m. Eastern Time. 5 p.m. Eastern Time is generally going to be the opening of the Sydney session or the Australian session, and then the Japanese sessions opens at, like, depending on daylight savings, either 7 p.m. or 8 p.m. That's the opening of basically one trading day around the world when the cycle begins. So you're finding another term for this is the Austrasian session, when you combine the Japanese and Australian sessions together. So what you're looking for is the high and the low price from 5 p.m. to 2:59 a.m. Eastern Time, and you're going to look to calculate the range. Now, when I say look to calculate the Asian range, what that means is you're just going to look at the high and the low price between these time frames right in here, and you're going to find how many pips did it move from 5 p.m. to 2:59 a.m. Eastern. 3 a.m. is the actual opening of the London session. That's when the largest amount of institutional traders really in the Forex markets to happen to reside in banks in Europe and London, and they tend to push market momentum in one direction or the other. So looking at this, on the 5-minute chart, a lot of times you'll find that it can fool you sometimes when you're looking at a 5-minute chart, because when you look at a move that's occurred like this one right in here, you assume that, like in this case, the euro dollar has exerted a huge amount of movement, but it actually has not. You see a big spike in movement, but it's actually not a very big move at all whatsoever. So all I'm trying to do is I'm trying to find the high and the low price during this time. If you look at these vertical lines on my chart, this signifies 5 p.m. Eastern Time. This red line over here is 3 a.m. Eastern Time. And so all I'm looking for is asking the chart a simple question. What was the low and what was the high during this time frame? So we have the low at 1.354, I'm sorry, the high at 1.35479, the low at 1.35233. So we calculate the Asian range has been 24.6 pips. Question would come up, why is this important? Well, one of the main reasons why this would be important is because we need to ask the chart a simple question. If you're trading euro dollar, which is the most actively traded pair in the foreign exchange markets, by far the largest amount of volume flows through the euro dollar pair. We want to know, was the euro dollar during the Asian session, was it what we call consolidated, or did it exert momentum? What we mean by this is we need it to be in what we call consolidation mode, meaning it hasn't exerted the largest amount of price action for the day leading up to the London session. Question just came up, well, how does PitView fit into this? Well, be patient, because one of the key things that I try to teach people is that PitView is the ultimate confirmation tool, in my opinion. And a lot of times it helps if you actually have a trading method or know how to trade at least a little bit, have an idea of what you like to buy and sell and where before you start utilizing it. Because if you just blindly take an indicator and buy every time it goes green and sell every time it goes red, you're going to be placing a whole hell of a lot of trades, and you're going to be whipsawed in and out a lot. So a lot of times you want a good setup to go along with it. So there's the high, there's the low, and the Asian range being 24.6 pips. So now we're going to determine consolidation or momentum. Now this is what we call a trade filter. And not only are we using this as a trade filter, but we're also using PitView as a trade filter on this individual method. Consolidation would be defined and this is how we define it. Whatever number you get for the 30-day ATR on, let's say, the euro-dollar pair, if the range during the Asian session from 5 p.m. to 2:59 a.m. Eastern time is less than 50% of whatever that number is for the 30-day ATR, you would move on to step 4. That means you have the okay to place a trade. That means that you would define the market as being in consolidation mode during the Asian session. If the Asian range is at or more than 50% of the 30-day ATR, then you would not have a trade, meaning the purpose of a trade filter is, you'll see that the entry and exit for this method is very simple. The purpose of a trade filter is it either gives you a red light and says, you know what, the market conditions are not optimal for you to place a trade right now, so don't trade this, or it gives you a green light and says, the market conditions are optimal for this trading method, go ahead and take your entry when it occurs. That's what a trade filter does. A lot of the greatest trading methods out there in the market, when you look at what the actual entry and exits are for the method themselves, are very simple. Some people might just use a moving average crossover, but it's the filter that goes into it, the optimal trading conditions in which traders look to trade those methods that make them so good. So the current euro-US dollar example, 50% of the 30-day ATR is 25 pips. Our 30-day ATR comes in, the Asian range of 24.6 pips is less than that number. So that means we can move on to step 4. If this was 25 pips or more, and yeah, you can be very exact on this, then we would just not trade. Some of the best trades you take are some of the best trades you make are the trades you don't take, as one of my wise mentors once told me. All right. So that would bring us to step 4. Now that we know that we can define the Asian range as being in consolidation mode, now we can move on to step 4, which is our entry and exit. The entry is very simple. You need to enter after 3 a.m. That's the London, 3 a.m. to 12 p.m. Eastern time is the London open to close. This is your kind of green light territory in which to place a trade, where you can enter into a trade. I tend to trade this my times tend to change. I have to be very holistic whenever I teach this strategy because it is called London Breakout, of telling people we'll only take trades, only take entries for these trades during the London session, which is 3 a.m. to 12 p.m. Eastern time. Depending on what the market conditions are, and this is something you can't teach people, is depending on what market conditions tell you, a lot of times I'm really not taking a trade on this. If the breakout has not occurred, if I haven't gotten a trade by like 8 a.m., the opening of the U.S. session, generally speaking, I'll move on to other types of trading methods from there. That's 8 a.m. Eastern time. That's just because a lot of times if you don't get a forceful move, in that 5 hours when the London session opens, a lot of times it means that there's just a lack of volatility during that session. But technically, if you have to be holistic, you can take a trade anywhere between 3 a.m. and 12 p.m. Eastern time as far as an entry order goes. There's also a buy entry filter, which is what we call a whipsaw filter. Before I show you what the buy entry is, I call it a whipsaw filter because this is how PitView has helped me in this. Okay, this is where we actually get to PitView. Pair view, which is one of the tools that we use here at PitView, the 1 hour total and 5 minute total sections, in order for me to take a buy entry, have to be green. And yes, it can be as simple as just being green or red, essentially. What that means is, in order for me to get a buy entry, the imbalance on the pair that I'm trading has to favor the execution that I get. So the 1 hour total, I look at that, and the 5 minute total, since I'm using a 5 minute chart, both have to be green. They have to line up as green. Those imbalances, I don't care what the numbers are inside those boxes. I just care what color those boxes are. So if they're both green on the 1 hour and 5 minute time frame, then I'm in good shape to take a buy. I can go ahead and take my buy. If they're both red when I get an entry, then I can go ahead and take a sell. This is this little filter right in here using PitView. When people complain about prices for tools, this has kept me out of so many bad trades that it's literally saved me hundreds of pips in my trading just by using it as a filter for my trades. In my opinion, that's very much well worth it when it comes to the bad trades it keeps you out of. I know a lot of people want to, hey, they want to just look at it on its own and just buy when it's green and sell when it's red. But it can be as easy as just being green or red just to confirm a trade for you. So the buy entry and the sell entry look like this. After 3 a.m. Eastern time, that's right when 3 a.m. Eastern time hits, and that's 8 a.m. London time for you folks that live in the UK. After 3 a.m. Eastern time hits, if the 1 hour total, whenever I put T on there, it means total. If the 1 hour total and 5 minute total is green, you would buy when the price breaks the Asian high by 1 pip. Okay? Meaning it has to break out into a new high by 1 pip. You're looking for just a breakout by 1 pip. If after 3 a.m. Eastern time, if the 1 hour total and 5 minute total is red, you would sell when the price breaks the Asian low by 1 pip. So you need those to line up together, okay? So when you're looking at this, what this would look like on a chart, and I'll show you what the exits are also here. Here's our euro-dollar example. Now this is what we call pair view right up in here. And what we're looking for is you see right down in here that we get the price breaking the Asian low, and it breaks the Asian low by 1 pip. At the same time that it's breaking the Asian low by that 1 pip, the 1 hour total, the question on here is the totals. What does the total do? The total down in here is what pair view is doing, essentially, is it's taking all the liquidity providers. I don't see how traders just don't think this is the coolest freaking thing on earth. It's taking all the liquidity providers based on what their actions are at the bid and ask price, whether they're leading inside the bid, whether they're following inside the bid or ask, if you will. And the total screen is an algorithmic total of these two things. For those of you who are brand new, I usually teach more basic examples of PitView on Wednesday mornings. But leading versus following, leading means that it's giving you the buy or sell imbalance based on the activity a market maker has done when they're leading inside the bid and ask. And what leading inside the bid and ask means is that it's very aggressive. When a market maker, if the bid and ask is, let's say, 1.3500 on the euro dollar and the ask is 1.3501, if a market maker is on that bid price to where they're willing to buy at 1.3500 from you and they raise that bid to, let's say, 1.35002 to create a new bid price, that's called leading inside. That's very bullish. It's very aggressively bullish when they lead inside like that because they're creating a new bid price. They're willing to buy at a higher price. Following is when, if the bid is 1.3500 and the ask is 1.3501, if you remember, we have multiple market makers on PitView. If one market maker raises their bid to 1.35001 and the other market maker was still sitting there at 1.3500, they see that other market led inside the bid, and they'll raise, instead of leading inside that other market maker, they'll join that market maker at that bid price. That's called following inside the bid. Both are considered bullish changes to your bid or ask price. What the totals do, it takes an algorithmic total of those two things. Different PitView traders, what I find is that they'll either look at the leaders or they'll look at the totals when it comes to their trade confirmations. So the 1 hour total down in here, what this is doing is this is telling you based on 100% of the market maker activity being tracked that the 1 hour total is red. It's showing a sell imbalance on the euro dollar of -3.45. And the 5-minute total for the last 5 minutes is red also, showing you a sell imbalance of negative 0.811. It's red. You don't even have to know what the numbers are in there. It's just red. It's a slight shade of red, but it's still red. This is telling me that when I get this sell trade, when this entry occurs, that it's lined up with where the market maker activity has been at the bid and ask price, meaning the market makers, based on 100% of the action, favor the bid, favor selling the euro dollar also. They favor selling this pair. Why? Because there's a sell in what we call a sell imbalance. So if those two things are lining up, if pair view shows red in the 1-hour total and the 5-minute totals, what would be our action here? Well, that would confirm our entry. It's broke the low by at least 1 pip. Pair view is red on the 1-hour. It's red on the 5-minute. We're lined up with the market makers. So we would have a sell entry here at 1.35223, which is 1 pip below the low price during the Asian session. Okay, we'll come back to this, by the way. I just want to I want to show you the entry, how it's confirmed by PitView on here. How does this save you from a whipsaw? Well, a lot of times, and this happened this morning on the dollar Swiss, and I'll show you a live example of this. A lot of times when you get an entry, if it doesn't line up with pair view, what I've found in my own trading is that I'll get an entry order, because a lot of times, whether it be, I don't know, some people might call it stop hunting, to where they'll try to stop out orders before they move the price in the direction they want it to go. A lot of times it's hard for a market maker to hide that if you know exactly what they're doing at the bid and ask price. So if these things were green, okay, up here, and this was giving me a sell trade, a lot of times what have happened is I'll ease off. I'll back off on this strategy. I'll say, nope, I'm not, even though this has broke the low by 1 pip, I'm going to wait for these to either go red, and if they do not, I'm not going to take the trade. And a lot of times if these two areas right in here are green, okay, then what happens is this will come all the way back up and stop me out and whipsaw me out of the trade. If it's showing the alternate or the opposite imbalance on pair view that goes against my trading signal. And that's the only problem with a strategy like this, is that just like any strategy, you have the risk of being stopped out. As far as my stop, it's the opposing signal. Your buy entry is placed 1 pip above the Asian high, and your sell entry is placed 1 pip below the Asian low. Whichever one triggers first, that is the only valid entry for the day, by the way. I don't know if I wrote that on here. You're only going to get, you only have the possibility per pair of getting 1 signal on this. If it breaks the Asian low first, that is giving you a London breakout sell signal. You can no longer take a buy signal. There's only 1 potential trade you're going to have on this a day. You're trying to trade the range, and so if you get a sell entry, your stop is going to be placed at whatever the buy entry price was, which is 1 pip above the Asian high. If you get a buy entry, your stop will be placed 1 pip below the sell entry price, which is 1 pip below the Asian low. So whenever I say stop at the opposing signal, that just means if my sell entry triggered, my stop is going to be placed at the same price as my buy entry. Why? Because we want to make sure that we give the market what we call room to go. And the limit, minimum limit, is 1-to-1 risk reward, which based on where your stop order is, that'll tell you exactly where your limit should be. So if your stop order is, let's say, 25, 26 pips away, you're going to risk 26 pips to make 26 pips. So whatever the amount of pips is of your stop order, that would be the amount that you're looking to reward yourself with. The other way that you can use pair view, this is a discretionary way to use it, is I talked about how PitView can confirm your trades. The other thing it can do is, as trades are moving in your favor, if you see, let's say, when a sell entry occurs, that the pair view, let's say, is still red, and you're gradually making money as you've sold it as it's gone down. Once your 1-to-1 risk-reward ratio is reached, what you can do is maybe move your stop to lock in that profit and keep that thing short. And this is discretionary. This is just a way that you can manage the trade to try to get a little bit better reward. But if you see the same thing screaming down and pair view matches up with it, you can also wait till the 5-minute total shows the opposing sentiment, the opposing imbalance prices. I can show you a little bit of how that works here in just a second. So this would be our sell entry here at 1.35223. Our stop would be placed right up here at 1.35509. And our limit is placed at a 1-to-1 risk reward. We're risking 28.6 to make 28.6. In this case, in this class example, we saw that this thing screamed down and hit our max profitability. All right. Now, as far as how, before we go live and take a look at this, without that PitView filter, at the time of doing this presentation, I didn't update it because we just wanted to do a review session. At the time that I did this, we had 12 winners and 8 losers as far as going back the last 20 trades upon where we got a valid signal on this trading method. And this was just tracking the euro-dollar pair, by the way, on this one. So 12 winners and 8 losers. Now that's without the PitView filter. If you go back and you track the last 20 trades with the PitView filter, there's only one winner that you would not have gotten. You would have still gotten a higher average win rate on this system. The PitView filter would have kept you out of one of the winning trades. Well, yeah, you would have missed one winning trade. However, it would have also taken away 5 of your losers. Meaning when we add that little PitView as a trade filter, it cut out one of our winners to where PitView didn't line up with our entry for one of the winners, but it cut out 5 of our losers. Now just think about that for a second. If you can cut out 5 of your winning trades, when you look at this, you know, the trading scenario on this goes from what being like a 60% win rate to being 11, you got 14 total trades in this case, to where you got almost an 80-something% win rate by using the PitView filter. That's pretty freaking powerful in my opinion. You know, yeah, we lost one winning trade. However, we also did not participate in 5 of the losing trades. So that was tracking that same 20 trades. This was 20 trades total. However, this was only 14 trades total, but we cut out the 5 losers, 5 of our losers. We only had 3 losers. You'd have to be a trading geek like me, but that's the reason why we use tools in the market to confirm order flow for us, such as this with these imbalances. It's very powerful stuff. Now, other ways to use PitView in this method, it can be traded using the euro, the pound, or the Swiss. You can use global view. Since you're using a short-term trading method, once 3 a.m. hits, if you're trying to decide which pair to trade, you can look at the 1-hour totals on global view to find the strongest to weakest currencies as far as the euro, the pound, and the Swiss. So you can look for whichever one is either the, sorry about that, hold on one second. You can look for whichever one is either the bully or the wimp in the schoolyard. For those of you who participated in my comparison analysis class, looking for the bully and the wimp in the schoolyard to pick a pair. Active trade management. People always ask me what type of imbalances to look for on PitView. That would be good solid entry methods of what really is would be defined as a large buy or sell imbalance, to where you can look for large movements to occur off of. If you look for large plus 20 or minus 20 imbalances on the 5-minute totals to exit trades earlier or stay in longer, that means a 20% shift in the imbalance between the buying and the selling pressure on what you're looking for, the buying and the selling imbalances. what a plus 20 and minus 20 means, for those of you who participated in the basic class, is that we have the bid and the ask price, right? If the market maker or liquidity provider, and sorry for the bad drawing on this, if the liquidity provider raises their bid, which is bullish. Remember, when a liquidity provider raises their bid price, that's bullish. I know that's where you, the retail trader, sell your, that's where you sell, but there's somebody buying from you at that bid price. Whenever that bid price gets raised, that's bullish. So if a liquidity provider raises their bid 60% more than they lower their ask price during a certain time frame, that means it's a plus 20 imbalance. That means they've raised their bid price 20% more than they've lowered their ask. That would be considered a large imbalance, because generally speaking, market makers want to keep if market makers had an ideal situation, they want to keep their bid and ask action because they're making the spread between the bid and ask. An ideal situation would be 50-50. So plus 20 means that there's a large shift in sentiment, if you will. Minus 20 would be if they did 40% of their action at the bid and only 60%, and they did 60% of their action lowering their ask price, that would be a minus 20. And that would also signal a fundamental shift in this strategy. It's very powerful when you get to know how these things work. As I've stated to a lot of my students, before we go live, let me also show you trading reversals, and then if we have any time here at the end of class, we'll go live and take a look. Well, in fact, let me just do this real quick. Let me go into a chart before we do anything else. Let's go to an example on dollar Swiss from this morning. You should be able to see my MetaTrader here. Let me zoom out a bit. When looking at a strategy such as this one, let me show you what occurred this morning. All right, here's the dollar Swiss pair on a 5-minute chart. I've been using dollar Swiss quite often on this strategy. Now, when you look at the buy signal, this is 5 p.m. Eastern, and this is 3 a.m. Eastern on the MetaTrader platform, 2100 to 0700. These times can change from platform to platform on MetaTrader depending on how they have it set up. But when you look at the range on the dollar Swiss, move this thing over a bit. When you look at the range on the dollar Swiss between these levels, it only moved about 15 pips during the Asian session. From this low to this high is about 15 pips. Now on this strategy, when you put in your buy would be put in once it breaks the Asian high by 1 pip, and your sell would be once it breaks the Asian low by 1 pip. In this case, it did break the Asian high by 1 pip. However, this morning on PitView, when it broke this Asian high, if you were to look at something like, let me show you the pair view on here. It's showing all green now. Here we go. Let me put this as topmost. There we go. This is pair view, and if you need any refreshers on how PitView works, make sure you attend my basic class, because I go through a lot of the basics on how to customize these time frames and how to look at these different things. It's kind of an assumption when we get into more of the intermediate levels. Like right now, you see how the 1 hour total is showing a positive 3.81 and the 5 minute total is showing a negative 10.58 on the dollar Swiss. Well, much the same this morning. When this actually gave me my buy signal this morning, this was showing, actually in the 1 hour total, it was showing red, and the 5 minute total showed green. And those never matched up this morning as we were looking at this on the 5 minute chart. And so it never gave me a valid buy signal. So when you look at what it's done since then, and we're only a couple of hours away, and we're in the morning session, and it's not a very volatile day at all on the dollar Swiss, but I was pretty happy with that because of the fact that during this time, when you look at what occurred, it's had a hard time breaking into any type of profitability. In fact, now that I'm reaching into 10 o'clock, I'm really glad that PitView kept me out of this trade, because even though that it's come down, this trade at no time during the day with the spread that you pay when you're trading, the buy signal is the valid signal on this. The stop would have been placed 1 pip below this low, risking 15 to make 15. However, at no time during the day today has this been a profitable trade, which is extremely odd in this case. Not extremely odd, but it's where if something gives you a buy signal, it didn't come down and stop me out yet. If I would have taken the signal, I would have still been in this trade this morning. PitView kept me out of it though, and this is one of those circumstances with the low volatility in the market. A lot of times, if something does not occur, I know I tell people to trade between 3 a.m. and 12 p.m. during the London session. However, for me personally, when I wake up in the morning at about 8 o'clock, if this thing has not triggered yet or has not gotten me into a trade, I'm not going to take any trades. In this case, PitView never lined up for it, so I never took a buy signal, and I was pretty happy about it when I woke up this morning, because there would have never been a point where it was a winning trade. And as we get closer to noon, volatility tends to dry up on something like the dollar Swiss pair. And even right now, it's not giving you any, even though it's heading to the upside, it's showing you a negative 30 imbalance here on the dollar Swiss. Some of you might be saying, well, Steve, why not take a sell on it? Because volatility is pretty much dried up during the day. Part of trading is knowing actually when things move, and as we get closer to the noon time frame, the probability in a low news day like this of the dollar Swiss making a significant move is very low. So I'd probably just not take any type of signal on this whatsoever. But you see the imbalances don't match up to buy it anyway. And you can see it's having a hard time breaking this high right in here. It's formed a resistance level. And you can see how it's matching up with the sell imbalances every time it tries to break that resistance level. So I'd probably be staying away from this one for right now, because it just doesn't match up as far as the buys and the sells go. You can see oftentimes with PitView, once it reaches these resistance levels, you can see how the sell buy and sell imbalances do not match up with the breakout that's occurred. So no, I probably wouldn't be doing anything at this point. These look like big moves, folks, but this is a range right in here of about 6 or 7 pips. And even when this breaks out, I don't get too excited, because this move right in here is like 1 or 2 pips. This thing is just not moving. You gotta look at and take sometimes things for what they're worth. All right, so that's an example of how it kind of kept me out of a trade this morning that I was pretty happy about. It's breaking into a high right now, but I would still kind of stay away from this one because it's not matching up with the pair view. Pair view is still at like a negative 18 on the last 5 minutes. That does not look like a pretty breakout at all to me. It's another way to use PitView, though, if you're just using simple support and resistance trading. If this were a green positive 20, maybe we might consider it. But it's not. It's showing that this favors selling the dollar Swiss, that the market makers have a lot of activity on the ask price. Don't trade for the sake of trading, especially on a Monday morning. All right. With the last 5 minutes or so, that was an example of trading momentum. with our London breakout strategy. Let me go ahead and minimize that window. And let me take a quick 5 or 10 minutes, because once you know London breakout and how that works of trading the first momentous move for the day, trading reversals is actually pretty easy. It's one of the easier subject matters that we went through. So trading reversals with PitView on the 5-minute chart, this is another thing that gets confirmed really easily by PitView. Another great example of PitView as a confirmation indicator. What you do when you trade reversals is you want the market to have eaten up a large amount of its momentum for the day. Meaning with the ATR, what we look at is the average true range, is we're essentially looking at what the expectation is for movement, correct? Well, when trading reversals, what you try to look for is high probability situations when the market has gotten into what we call an overdone condition, meaning it's gotten to a high probability scenario where the probability of it moving any further in its directional move has been eaten away by the range that it's had. So when trading reversals, this is not trading momentum, this is trading reversals. What we do is we wait for price, just like down that 30-day ATR, we would wait for price to exert 80% of whatever that 30-day ATR number is. For example, the euro dollar, if the 30-day ATR is 50 pips, the trade filter for this is once price has exerted from the low down in here to the high right up in here, you need for the euro dollar to have exerted about 80% of whatever this number is. What this means is when you wake up in the morning and you see that this large amount of movement has happened, a lot of times with a lot of traders, their knee-jerk reaction is to buy the euro dollar. Well, in this case, if the euro dollar moves 50 pips a day, and let's say the range from this high to this low is 40 pips, and you know that it only trades 50 pips during this time frame, what's the probability of this moving any higher? Remember, when you go into your trading day, what you're saying to yourself is, okay, the euro dollar moves an average of 50 pips a day. A lot of traders would come into the morning here during the U.S. session, or like during the London session in this case, and they would say, oh man, look at the euro dollar, it's screaming up, I should buy it because I trade with the trend because the trend is our friend. However, when you see a move like this occur, the probability weighs against you for buying the euro dollar. I know the big uptrending move right in here looks sexy from a buy standpoint. However, it's already exerted the majority of its range. So 80% of 50 pips is 40 pips. And so you wouldn't be looking to necessarily buy the euro dollar at this point because the probability of it moving any higher from this standpoint is very, very low. What you'd be doing is for this to correct upon itself and move down because it's in what we call an overdone condition because it's exerted the majority of its range. You know, things go up, down, or sideways, and in this case, you can either buy or sell in the market. You can either buy for it to go up or sell for it to go down. In this case, the probabilities have really been taken out of the equation for you to buy and expect this based on its average range to move any higher for that time frame. So you'd only be looking to sell it in this case. Now, what do we use for the entry and exit? If you're getting a buy entry, it's the same thing. Only this case, we use a 10-period and a 30-period simple moving average. It's just a simple moving average crossover technique to where once something has exerted 80% of its range, you're going to wait for a cross to occur on the moving averages to give you a signal. Again, some things are not about the entry. The entry is just a moving average crossover. And this is on a 5-minute chart. For one thing, in order for us to take a trade, we need for it to have exerted its range for the day, or 80% of it. And in order for us to get a buy entry, same thing. We need the 1 and 5-minute pit view. It has to be confirmed green. And the 1 hour, 5-minute pair view, if we're getting a sell signal, has to be confirmed red. When the cross occurs. So this is a very simple strategy. When you look at what you do with it, I mean, you're just waiting for it to exert a range, and then once you get the opposing signal on the moving average cross, you're getting in only if PitView confirms it. And this is another way that PitView can keep you out of a large amount of whipsaws in the market. The stop, when I say 1 pip above or below the previous swing high or low, that means that before the cross occurs, you're looking at, for whatever, on sell signals, you're looking for whatever the previous high was for that intraday move. And for buy signals, you're looking at whatever the previous peak low was on the previous move. Limit, again, this is a nice little one-to-one risk-reward scenario, or you can also look for larger risk-reward in this, given the time frame that you're looking at, and the amount of move that you can expect and how sharply it declines. So in this case, here was our negative cross. This is when the moving averages cross below. You see the price came up. It exerted a large amount of its range from its low to its high. It started coming back down. We got a negative cross on the moving averages. And then when you look at the pair view, if you need to, you can just pull up the totals. The pair view shows a red, negative 3.25 and negative 17. So not only is this reversing course, but the market makers are also confirming that it's reversing course. So this would give you a sell signal to look for this to trade further to the downside. The stop and limit on this, so there's our entry, 1.36243. Our stop, again, here's where the negative cross occurs right here. What we would do is we would look back at whatever the previous swing high was. We put our stop run at least 1 pip above that high, and then put our limit at a 1-to-1 risk-reward ratio. In this case, we'd be risking 15 to make 15, or 15.9 to make 15.9. This is a very simple reversal strategy for trading intraday in the markets. It goes along very well with the London breakout strategy, because after momentum has been eaten up for the day, all you're looking for is taking the opposing signal. Now, oftentimes what students will ask me is that, especially when it comes to these reversals, is they'll ask me, okay, well, Steve, is there a way to get into this type of strategy earlier? You know, when we look at, here, let me change my ink color. So is there a way to get into this strategy earlier? Because by the time it gives us a sell signal on the moving averages, it's already moved quite a bit. It's already moved about 15, 16 pips to the downside once we get an entry signal on this strategy. Well, there is a way to get in earlier on a method like this, and that's by looking at the actual 5-minute totals themselves. If after it's exerted 80% of its range, which occurs right in here, if you get the PitView on the 5-minute totals go to a negative 20, that would mean a negative 20% imbalance. Once it reaches negative 20 inside this 5-minute box, that can actually give you an earlier sell signal, which did occur right around in here on PitView. You see it hit the maximum amount of its range, and on the pair view, I should say pair view, on the pair view, this turned into a negative 20%, which showed you an imbalance of negative 20. It went to like negative 21. This is an opportunity to where you're still using the reversal strategy of it, if it reaching 80% of its range for the day. But instead of using the moving average crossovers as your entry, you can actually use PitView itself as an entry. You can use the pair view as your entry method on your trades. It's really, really powerful stuff, because once it's hit 80, once it's exceeded its range for the day, when it's reached these tops right in here, once it's exceeded that range, the probability of it going up any higher is very low. There's a low probability of it going any higher. In fact, when things can only go up, down, or sideways, if it's already exerted its range for the day, very low probability that it's going to go any higher. So basically what you're doing is, once things have exerted their range in this case, is any excuse you can come up with to short this anything to confirm a trade for you is what you would sell to enter. In fact, a lot of my students ask me if they can use stochastic or MACD or RSI with this method, and I say, use anything you want. If you don't want to use a moving average crossover, use anything you want. In this case, you can use the pair view as your actual confirmation itself, because you're already looking to trade it to the downside. You're just looking for an excuse to sell it. So negative 20 to negative 20 on this. The euro dollar had already moved 40 pips. I knew I had it on here. It was like negative 21. In this case, it moved to a negative 21. And that same chart, you can see there's where your entry was, right in here, where using the pair view as an entry tool. You know, wait for it to go to negative 20 to enter into the trade. Using pair view as an actual entry tool could have actually gotten you into the trade earlier. And by the time it would have hit your entry on the moving average crossover, pair view could have gotten you into the trade, and you would have probably already came very, very close to actually hitting your max profit, or hitting a max profit on the trade. And you can also wait when this thing starts going down. You can wait for the 5 minutes. Once you hit a profitability level, if you want to stay in the trade longer, you can look at these 5-minute totals and just wait for them to go green. Some things can be as easy on PitView as green or red. You know, you get an entry. You know, I've already hit my 10 pips of profit. I'm going to wait for I'm going to stay in this a little bit longer and let this move a little bit further in my favor. Wait for PitView to go to positive territory, and then get into my trade. As far as going in and doing some other live examples, when we meet up as a class next Monday, I'll go through, we're going to start in, I just wanted to do a review of our short-term trading methods. Those are two great little trading methods to use in your arsenal, and you can see the power of how PitView works behind them. For those of you who are brand new to PitView, if you're a brand new student to PitView, don't worry. On Wednesday mornings, I teach more basic content. This is called our more intermediate content as far as utilizing it into your trading strategy or trading method. Wednesday mornings, I generally go back to the basics a bit more. So you're welcome to attend those classes on Wednesday mornings. Those are available on our website at pitview.com. If you are looking for a trial on PitView, you can go to this website, www.pitview.com/web. And you can subscribe for a free trial. You can also, there is a summer subscription rate for those of you looking to renew your subscriptions or to subscribe to PitView, which you can get a bit of a discount off going to this website right in here. Any questions for me, shoot me an email. I was on hiatus. I was gone last week, so I apologize if I haven't responded to you yet. Ryan, I think you're in this class. I think I sent you the PowerPoint that you had requested, but you might want to back me up on that. But I'm pretty sure right before I left that I got you on that. So let me know if you didn't receive that. Any questions on trading methodology, if you will? I not only am the chief market analyst or senior market analyst for PitView because I do love this tool so much, but I also run educational courses on just, you know, if you're one of those traders that are having a hard time of finding an actual trading method in which to trade, if you are more of a swing trader, I also teach education courses on just trading methodology itself, on trading strategy and trading methods, news trading, long-term trading, options, binary options. So if you have any questions or want any information on that, you can shoot me an email at pitview.com. And Bader, I thought I sent you the presentations also, and you should have gotten a user ID and password, but let me know if you have not. You can shoot me an email on that also. Other than that, it's time for me to go. I'm going to go ahead and stop the recording. I want to thank you for coming in today. This is Steve Nury signing off, and let me know if you have any questions. Bye-bye, everybody.